Most real estate investors don't fail because they bought the wrong property. They fail because they make a few costly mistakes before they ever get started. Today, we're going to be talking about the biggest rookie mistakes real estate investors make. Hello, everyone. My name is Flo Jacques, licensed real estate broker here in Raleigh, Durham, North Carolina, and investor. And I'm excited to talk to you guys a little bit more about the rookie mistakes investors make, including the ones I made when I bought my very first investment properties. Not just the first one, because you learn along the way the mistakes. I hear so many people experience analysis paralysis, and part of their paralysis is fear, the fear of the unknown, making mistakes. And one of the biggest things I've learned is that you've got to get started in order to start learning and growing. It's not just going to happen to you. You're not going to perfect it before you can even buy your first investment. Instead, you've got to do your first project and learn from that and keep going in order for you to be a pro like those who's been flipping 50 houses a year. So the very first mistake I see rookies make is waiting for the perfect deal. Every deal that you see on the market or off market might not be the best deal. And so we're not saying to go after a property just because the numbers are there. It's definitely going to require some research and experiences. And I will certainly encourage you to take a look at some of our past Fridays with Flows where we've talked about what makes a bad rental property. Check us out because that's definitely one to listen to as you're deciding on your first deal or your next deal, actually. As I mentioned, analysis paralysis is something that I hear from students and people all the time. I say students because I do have some members of my investor academy, the restorative-collective.com, where we get a lot of mentees who are starting their first deal and looking for mentorship. And in the community, I hear some people post issues and concerns with not making a mistake. And investing is something that certainly is going to be a risk, right? Something that's hundreds of thousands, tens of thousands of dollars that you're investing in a rehab. Some people, your rehab budget might be over $100,000 in addition to the purchase price. So it's very valid to kind of analyze and process and make sure that you're not necessarily making a mistake. That's very important. But there's a fine line here and to making sure that that's not going to hold you back over the next couple years. Other things that can make someone make the rookie mistake of trying to wait for the perfect deal would be waiting for the market to crash. I mean, even traditional home buyers looking for a primary home make that mistake of waiting. And then just before they know it, home prices rise up again and they miss the opportunity. Whether it was when rates were at 2% historic lows, and that caused the housing market to increase in home values because so many people were buying at the 2% rate. And now we're in a position where home prices have increased and still people are not interested because the interest rate is higher and they're waiting for things to completely, like they say, housing bubble to burst. But I always say the deal is out there. It's all in what the seller is willing to do. And also waiting until you know everything is a huge mistake because you're never going to be perfectly ready. You're just not going to have everything at your fingertips. I think so long as you understand financing terms, you've calculated for everything you need for a project, for a rehab, and you've got your full-on game plan. You've got your plan B. What are you going to do with the property if the home doesn't sell? You're going to rent it and making sure that the numbers fit that ratio. If you needed to refinance it, what the rent could be. I think that's good enough to get started. But it's definitely important to have a mentor or somebody along the way that can help you with that experience. You'll learn more from one deal than from 100 hours of YouTube because experiencing the process is going to teach you so much more. The second mistake rookie investors make is just buying based on emotion instead of based on the numbers. I certainly made that mistake in my first property. And it really wasn't even because I loved the house. I just was so excited about buying my first investment property because I did invest in a 3-day real estate investors course. I did all the work in securing my hard money lenders and, kind of fully made sure that I had all my ducks in a row. And as soon as I felt like I was ready. I was looking at properties, researching them, and honestly, I settled on the first two that I bought. And granted, that was a good deal. I still have that property. I kept it in my portfolio. But the thing is, I did all the work instead of just getting so excited and pumped up and going after it. Although I negotiated a deal, I would have caught that it was in a flood zone. And I would have thought a lot more before I decided on moving forward with that property. So emotion doesn't necessarily mean that I thought it was my dream home, that I was going to live in it. Emotion is just simply you're so excited and you kind of forget all the other factors that come with the process to make sure that the numbers work. The numbers certainly are impacting my cash flow with the flood zone insurance. But if I thought a little bit more about it, I would not have to calculate for an extra $245 per month for flood zone insurance. The third mistake rookie investors make would be underestimating repair costs. That's a huge one. And to be honest, even experienced investors may underestimate repair costs. And I mean, to a certain degree, you might find out things that we didn't plan for, although experienced investors plan for contingencies, things that we may not know. I mean, to be honest, there's always going to be something that shows up that goes past the contingency budget that you plan for. I mean, I have friends and colleagues who are multi-million-dollar developers, and they are building $10 million, $180 million projects, luxury homes, mixed use condos and retail centers. And even they end up facing problems that can cost them $500,000 to resolve. Even though they had their contingency budget planned out, they still end up in scenarios where they didn't plan enough. And so an example would be where I was talking to a friend and he was telling me that they broke ground on their new construction project and discovered boulders underground. And if you know anything about finding boulders in the ground, it is hundreds of thousands of dollars to remove. The digging, the removing, and not only is it costing so much more to remove the boulders to be able to move forward, it also is costing more time. And truly, we always say time is money, and some people don't necessarily believe in that because health and other things are so much more important than time. You know, you'd be willing to give up everything you've got if it means you get time back with your family or your health back, blah, blah, blah. Yes, it's true in that fashion. But in the world of investing, time is truly money because he was paying $56,000 a month in interest only payments for a project that he was taking on. Now, granted, those are the big dogs. Those are the people, again, building multi-million-dollar projects and have been in the industry for 34 years. So this is an experienced investor. So truly, when I tell you that there are a lot of mistakes that you're going to make along the way, you're going to end up going over budget in some capacity. It's definitely expected to go over budget by 20%, but no more than that. Even then, again, there's some things that you're gonna face that maybe you didn't plan for beyond your contingency budget. Either way, rookie mistakes that investors might make would be underestimating. You're better off overestimating so that when the problems come, then you don't necessarily feel like you are still figuring out what to do next. It's safe to say everything costs more and will take longer than you think. If you think the project's going to take you 1 month or 2 months, just plan for 4 or 5, because there's other carrying costs, otherwise known as holding costs. This is the cost of paying the monthly payment on the property or utilities on the property, insurance, those types of things. The fourth mistake rookie investors make would be not understanding your exit strategy. That is one of the very first things you should decide on before closing on the property. Is this a flip? Is this something that you're gonna buy, renovate, rent out, and then refinance it to keep it in your portfolio? Is this going to be a house hack? Are you gonna move in it? Those are very important things to discuss with you, your team, who all is involved before you go into the property. And lastly, the fifth mistake that I see rookie investors make is trying to do everything alone. That is going to certainly hurt you so much more than you think. Now, I will say that I have always pursued my investment properties by myself. You want to protect relationships. You don't want other people's anxiety amplifying your anxiety. Real estate investing is a risk, just like any investment. Buying a home just to live in. I mean, most of the time people are expecting that their home is going to appreciate in value, build equity, and sell that for more years down the line and buy another property. I mean, what if that doesn't happen? I mean, it's going to happen. Appreciation is always going to happen in the real estate market. Some markets are slower than others. Sometimes it's going to take you 5 years before you truly see growth in your property. In other market, it might take 10 years before they see growth in their property. Sure, you're definitely going to experience growth in real estate value, property value anyway, and if you're expecting to buy a home at $300,000 and then see it be worth $500,000 in 5 years, depending on what's happening in the economy, that's not promised or guaranteed. Some things have to happen in order for growth like that to happen, like the pandemic that happened in 2020, where a lot of people saw their home values nearly double. So in those scenarios where hundreds of thousands of people had to die, then you're going to see some abnormal things happen. But if you're planning to experience faster growth in value, that's not always promised. But overall, if you're looking at buying property alone, if you don't have the right lender partners, the right attorneys, contractors, I mean, another friend who's an investor that you could bounce ideas off of and ask questions, then it can certainly feel like a lonely and tough road. I always say get connected with your local REIA, your local Real Estate Investors Association. Every state and area has one. So reach out and look online and take a look and see what's nearby you to go and check out, because there are always other investors looking to network, connect, and just build relationships. Real estate is a team sport. The goal isn't to avoid every mistake. The goal is to avoid expensive ones that may stop you from getting started. Thanks again for tuning in to another episode of Fridays with Flo. And I always want to hear what you guys think in the comments. Please like, subscribe, and share this video with somebody that you know that could benefit from learning about real estate investing and rookie mistakes. And definitely check out our Investor Academy at therestorativecollective.com. And I'll see you guys next time. Bye.